In this first video, we will be talking about making an option index. We will answer the question, how can options be used to express a nuanced market view? Finally, we will answer the question, what does it look like if one strategically maintains a specific option position over time? An option index is a particular option position, say a 1-month in-the-money call, or an option spread, say bear caller, entered, maintained, and rolled systematically over time. There is a long history of long-only investing. Long-only bets are not nuanced, whereas with options one can express a view that is bullish with calls, moderately bullish with bull callers, short puts, or short calls, neutral with condors or strangles, moderately bearish with bear calls, short puts, and short calls, or bearish with puts. Constructing an option index requires some choices. The quarterly CME Group Electronic Options Spotlight reports liquidity statistics for products under consideration. The report highlights the average daily volume, open interest, and other statistics on the main product complexes of the CME Group, including interest rates, equity index, energy, foreign exchange, agriculture, and metals. The 10-year U.S. Treasury options averaged around 377,000 contracts a day in volume and 2.1 million in open interest during Q2 2014. The S&P 500 E-mini options also averaged around 375,000 contracts a day in volume and 2.5 million in open interest. WTI, Nat gas, the Euro FX, corn, and gold were also liquidity leaders in their respective product complexes in Q2 2014. An additional choice that must be addressed in the construction of an option index is the selection of standard strikes for the collars, condors, or whichever structure you will be valuing. Will I be using 3 strikes in the money for my call index? Will I be using a short call 4 strikes out of the money for the construction of my bullish caller index? How wide will the strikes on my straddle index be? The tenor and roll calendar are also unavoidable choices when constructing a standardized option strategy index. Will I be concentrating in the front month contracts with less than 30 days to expiration? Or do I want to represent a strategy with a little longer time between rolls?
So here we have our 9 proposed option structures. So I'm just going to go through each one individually, try to reiterate the actual nuanced view that's being expressed through each one of the positions, and just review how it performs relative to the underlying of the S&P 500. So starting off with the bullish caller. So a bullish caller is a view made up of 3 positions, 2 of which are options, a short call, which is out of the money, a futures position, which is long, and a long put. So you might engage in this strategy if you think that the market is going to go up, but not an unlimited amount. You might engage in this strategy if you want to limit your risk, because there is a hard downside limitation to this type of strategy. You aren't going to wake up 2008 or 1987 event and be out some potentially unlimited amount, because the risk of the static position limits your exposure to sort of black swan events. One of the other benefits of this type of strategy is that if you were to use leverage, that leverage can augment upside. It's not an unlimited amount of leverage to the downside, whereas if you were to buy 2 times the S&P 500, you're risking a lot of capital. But if you buy 2 callers for every 1 unit of S&P futures, you definitely don't have the same amount of risk, relatively speaking, as you would in a double levered S&P futures position. Downsides, if the market goes straight up, you have a limited risk in this particular position. Having said that, you can roll into higher strikes, but in this particular example, we're just setting the strikes, holding them for a month, and it seems to, in this window at least, do fairly well over the testing period, a return in excess of 50%, maybe just shy of 60% in this window, where the S&P is closer to the high 40s. So the long call on the S&P 500 here, again, similar argument to the bullish caller, underperforms the caller in this window because the S&P was not straight up. So the callers, relatively speaking, cost less because you were collecting some premium on the short calls. Having said that, the call position still seems to be fairly attractive, even though it underperforms the S&P, again, because if you were to gear it twice, you certainly could have a pretty hefty return and a pretty hefty potential with a static risk or fixed downside, which is much more attractive than a geared or levered version of the S&P 500. This particular strike selection is, I believe, 3 strikes in the money every 30 days. So there's some extra expense over the margin that might be required for the S&P 500. So the S&P 500 might have a margin requirement of somewhere in the neighborhood of $3,000 to $5,000 per one lot. In the money option maybe has a might cost $5,000 to $7,000, but that $5,000 to $7,000 is basically a fixed amount, which isn't going to grow, whereas the futures commitment could be required to increase if the market moves against you. So there are benefits to that sort of non-recourse leverage. So the neutral condor, this is where we really start to see big potential divergence between the underlying and the nuanced bets that are possible through the options. The point here being that if the market is not moving, if the underlying market is not in a trend, potentially the condor could be in a trend. And again, this is a bet that you can make bidirectionally, and it is a fixed risk bet whether you go long or short of that neutral condor. So there are situations where if you look from the 700-day mark or so, the index retreats from being up maybe 25% to being up sub 10%. One could have been short of that move had a signaling system been in place, and that would have been a closed risk way to get exposure to the market. Issue of correlations going in lockstep, that seems to not be as much of an issue as you would see in other products, because these spreads are specifically designed to express a particular view, and that view is fairly consistent over time. So bearish caller, again, mirror image of bullish caller, the benefits being you can get short of any product that you like. You can create one of these collars on, and you don't have the same unlimited risk that you would when someone gets short of an outright position. So that's one of the big pluses there. Additionally, you can choose the strikes width to either increase or decrease the level of volatility that you're going to realize in the outcome. But like the bullish caller, this type of bet is actually meant to take the concept of volatility out of the equation, so one doesn't really need to have a view of implied volatility to enter into one of these positions. So in the event that you were very bearish, you could have been buying puts, and over this period of time, again, it looks like it's lost in excess of 50% of its value. Strategies which are systematically short of options over a prolonged period of time. So this bearish strangle that we're looking at is again the same model of the roll calendar being every 30 days we are selling out of the money calls and selling out of the money puts with a slight bias to the bearish side. So through most of the time, you'll see that the bearish index, the bearish strangle index, it's more volatile than the underlying, but you can see the difference in the premium collection. So instead of the underlying market is over the window up maybe 45 to 50%, and the process of premium collection is gathering another sort of 10% over that testing window. But the path is a different path. So, and the risk is probably similar to the underlying. I don't think it's terribly controversial to say that it's a similar risk. Reason being that if you lose on one side of the strangle, you're going to win on the other. If you win on one side, you're going to lose on the other. That's sort of the lay of the land when it comes to the bearish strangle on the S&P. So this slide is just illustrating the similarity between the bullish and the bearish strangle. Again, they are very similar bets. Small differences occur around whether the S&P actually moves up to neutral or moves down to neutral. But both are structured, again, with out-of-the-money calls and out-of-the-money puts. And again, you can check the handbook if you want to get deeper into the actual structure of these positions. The last bets, positions here we're reviewing are the ratio call and the ratio put. So the ratio call is buying a call, selling two out-of-the-money calls. That bet basically says, I don't think the market's going to go up too much. So if you think if a particular market is not going to move up too much, you probably would adhere to a ratio call strategy. On the right-hand side, the ratio put strategy. We're sellers of two out-of-the-money puts and a buyer of one in-the-money put. Again, this type of strategy looks like it has paid off somewhat better in this particular testing window. But again, that is largely due to the fact that the underlying S&P in this case has moved up, and it's moved up at a rate which is not too fast, and it has not pulled back dramatically. If you did see points along the way where the market was to pull back dramatically, you would expect to see dramatic pullbacks in the ratio put. But failing that, it seems to be a fairly slow grind higher in this type of position. So what we were looking to do in this presentation is find out what we can do, broadly speaking, with options. Buy premium, sell premium. We wanted to look at the different nuanced views. So we illustrated 9 option structures, showed the different nuanced views that those different option structures express. And then finally, we were trying to answer the question, what does it look like when we strategically, over time, repeat a particular option strategy?
If you would like more information on the TMQR EXO indices, please go to www.tmqrexo.com. Over 100 option strategy indices on exchange-traded futures markets are updated daily. If you have any questions or comments, please email